Ever feel like your store is selling, but your bank account didn't get the memo? You're not alone. Shopify says 82% of new ecom sellers struggle to read their own P&L. And that's not a minor issue. That's the whole issue. Let's fix that. So first, what the hell is a P&L? It stands for profit and loss. It's basically just a report that tells you, did your business actually make money or did it just make noise? It shows you exactly how money flows through your brand. What's coming in, what it costs to fulfill orders, what you're spending to keep the lights on, and whether any of it is actually landing in your pocket. But most people treat it like a history book. Smart operators, they treat it like a diagnostic tool, like a blood test for your business. They read it regularly so they can catch tiny issues before they become profit leaks. And let me say this clearly. If you're only reviewing your P&L once a quarter, you're not running a business, you're gambling. I know 9-figure sellers who glance at the P&L every Monday morning because that one sheet tells them whether to scale up ads, cut slow-moving SKUs, or renegotiate shipping rates, or stop the order and wait. It's not about vanity numbers. It's about control. And that control starts with knowing how to read things like a pro. So let's start with the most visible number in your business, sales. It's the first thing you can see in your dashboard and often the first thing people brag about. But high sales don't automatically mean high profit. That's where a lot of sellers get tripped up. When we talk about sales in a P&L, we're talking about total revenue generated across all channels. That might include your direct-to-consumer side, your Amazon listings, other marketplaces like Walmart or eBay, and possibly even retail or pop-up shop sales if you're running those. From a financial reporting standpoint, it's all treated the same. It all flows into the top line of your P&L. But where it gets interesting is when you break those numbers down by channel. For example, I worked with a brand doing $500,000 a month in total sales. On paper, that looked great, but a closer look revealed that 70% of those sales came from Amazon, where margins were tighter and return rates were higher. The D2C side, so the direct-to-consumer side, while smaller, was more profitable and had stronger customer retention. That kind of insight changes how you allocate ad spend, where you focus retention efforts and which SKUs you prioritize based on margin and reorder rates. So it's actually about understanding where it's coming from, how reliable it is, and what's costing you to acquire and fulfill those orders. If you're looking at sales as one big number without the context of channel performance, you're missing the first lever in building a more profitable business. Now let's talk about cost of goods sold, COGS. This is where a lot of sellers either get lazy or just make assumptions, and those assumptions cost them. In e-commerce, your COGS is basically your total landed cost. That means the product cost plus freight, import duties, fulfillment center fees, and yes, even packaging materials. If you're only looking at the invoice from your manufacturer and thinking, great, $5 per unit, you're missing the big picture. Shipping that product from overseas might add another $1 more. Import taxes can stack up quickly, especially right now. And if you're using a 3PL to fulfill orders, you're paying per unit there too. Throw in your custom packaging and thank you cards, and that $5 product might really be costing you closer to $8. This is where your margins are either protected or quietly leaking away. And one of the most common and costly mistakes I see, sellers forget to update their COGS when suppliers' prices changes or freight cost increases. Even a slight shift can erode your gross profit and throw off your financial decision making for weeks, if not longer. So here's the bottom line. If you're not reviewing and adjusting your true cost structure on a regular basis, your gross profit numbers won't be accurate, and that makes it nearly impossible to scale intelligently. Now that you know what your sales are and what they actually cost you to fulfill, it's time for your first real checkpoint, gross profit. This is the number that tells you whether your business model even works. The formula is simple. Sales minus COGS equals gross profit. But don't confuse simple with small. This number is everything. It's the foundation for what you can spend on ads, pay your team, cover your software stack, and still have profit left over. So what's considered healthy? For most brands, whether D2C or marketplace sellers like FBA brands, gross margins in the 65 to 70% range are solid. But the real target? 75 to 80% margins. That buffer gives you room to handle rising customer acquisition costs, CAC, absorb fee increases, and still keep control of your bottom line. Here's a quick real-world example from one of the brands we own. a scented candles company we acquired in 2022. When we stepped in, their gross margins was sitting around 65%. Over the next 12 months, we negotiated better terms with their suppliers, redesigned the packaging to reduce dimensional weight, and pushed that margin up to 75% in a market where costs were rising, not falling. That 10-point improvement didn't just look good on paper. It gave us room to stay aggressive with marketing, invest in retention flows, and boost contribution margin across every SKU. This is why gross margins isn't just a concept or an accounting metric. It's your financial breathing room. When done right, it's what allows you to play offense, even in a high-cost market. So don't just track, improve it, defend it, and use it to guide your product, pricing, and supply chain decisions. Once you calculate gross profit, the next step is looking what's next, your operating expenses. This includes your ad spend, team salaries, freelancer, software, subscriptions, agency retainers, shipping platforms, customer service tools, basically everything it takes to keep the engine running after the product lands in your warehouse from the sourcing country. And here's where a lot of sellers start to feel blindsided. Expense creep. That's when costs slowly pile up. An extra Shopify app here, a new analytics tool there, until you're suddenly losing 10% of your margin without noticing. I've seen brands using 3 different SaaS tools to manage the same workflow, or keep an agency on retainer for work the internal team already does. Those recurring charges might feel small individually, but together they quietly drain your profit. There's a simple golden rule here that every operator should follow. Watch your LTV to CAC ratio weekly, not monthly. LTV, or lifetime value, is especially important for subscription brands. A simple way to think about it is the average revenue per customer times gross margin divided by churn. For non-subscription brands, LTV often looks a lot like an average order value, unless you have a strong repeat purchase behavior. The big thing to remember is that LTV changes slowly, but CAC, that can spike overnight based on your growth channel, app performance, or even the time of the year. So if CAC is climbing and the LTV stays flat, your margins are in trouble. Watch both. You watch CAC like a hawk. And here's a quick pro tip. Always track marketing expenses separately from operational overhead. Break out ad spend, agency fees, and in-house team costs by channel. Do the same for salaries, software, and subscriptions. It gives you cleaner comparisons month to month and helps you see what's really driving performance. At this stage, your job is to defend your margin from all sides, and operating expenses are where most of the hidden leaks start. And here's where everything comes together. After scaling brands, shutting down one that looked great on paper, and turning the next one into a margin machine, I realized most founders don't need more hustle. They need more clarity. That's why I built the profit framework. It's the system I use with every brand I work with to connect the dots between sales, margins, CAC, LTV, and every key number in your business. If you want to explore the numbers that really drive profit like CM2, CM3, and ROAS, check out the full video linked here. Now it's the time to shift from reading your P&L to actually using it. But before that, if you found this breakdown helpful, make sure to like the video, subscribe for more e-commerce strategies, and drop a comment below if you have any questions. Now, this is where the real operators separate themselves, by actually using the P&L numbers to drive decisions. Let's talk contribution margins. You'll often hear them referred to as CM1, CM2, CM3, especially in high-level e-commerce finance. CM1 is simply a gross profit, sales minus COGS, simple. But CM2 goes deeper. It subtracts your logistics and fulfillment costs, things like Amazon FBA fees, 3PL charges, and shipping to your customers. In other words, CM2 tells how profitable you are after you deliver the product to the customer, but before you factor in how much it actually costs to acquire the customer. And that's where CM3 comes in. That's after all your marketing costs, paid ads, influencer commissions, affiliate payouts, everything it takes to actually acquire a customer. CM3 is the number you want to obsess over because it shows how much profit you actually have to reinvest or keep. After CM3, you're looking at fixed operating expenses like your SaaS stack, your staff, your rent if you have a physical space, subtract those, and you get to your EBIT. And once you subtract taxes and any interest payments, say for example for revenue-based financing, you finally arrive at a net profit. This layered view gives you a more accurate way to track financial health at each stage. And it's especially powerful when paired with what I call P&L alert system. Here is how it works. Set performance thresholds that trigger action. For example, if your return rate goes over 10%, dig in immediately. If CAC rises 2 weeks in a row but LTV stays flat, it's time to pull back or test new audiences or strategies. Also track percentages changes month over month, not just totals. This shows you trends, not just outcomes. And don't overlook your SKU level data. The best operators I've worked with track profit per SKU. This helps them know which products are carrying the brand and which ones are quietly draining resources. Your P&L isn't just a report, it's a control panel. Read it weekly, react to it quickly, and use it to build a business that grows, literally. But while going through the whole process, it's important to watch out for some common mistakes. One of the biggest issues I see is misclassifying expenses. For example, a lot of brands lump all marketing spend into an ad platform cost and forget to include the full cost of acquisition. Things like your agency retainers, influencer coordinators if you use them, freelancers managing your campaigns, even full-time staff running Meta or Google ads. If you're spending $10,000 on ads, but paying another $1,500 to an agency to actually manage the ads, your true CAC needs to be calculated on the back of that $11,500 rather than just on the back of the $10,000. And when you're running multiple channels or using external help, that number can balloon quickly and you actually need to calculate CAC per channel and then a blended CAC across all channels. And yet most brands only track the ad spend, so they're underestimating what it actually costs to acquire a customer, which distorts every downstream decision from pricing to budget allocation. Another common blind spot, returns and chargebacks. Too many sellers forget to account for them when reporting revenue. If you're not subtracting returns, your numbers are inflated. You're making decisions based on money that's not actually there. Then there are tariffs. And this one is becoming more important every month, especially since the last update by Trump. If you're importing products, particularly from countries affected by changing trade policies, those fees need to be baked into your COGS. I've seen brands go out of business overnight because their numbers suddenly stopped making sense. Sometimes it was a new tariff. Other times, sharp rise in interest rates on the debt they actually took out. Either way, the impact was immediate and brutal, and the key is accuracy. Accuracy and attention to detail. Keep your records clean, update it in real time, and categorize correctly. Because at this level, small misclassifications compound into big financial missteps. Want to be informed on the best ways on how to increase your profitability? Join me and other ecom founders in my Telegram community. The link is below.